What financial risks do I need to transfer or protect myself from? Deeply embedded in our psyche is avoidance of loss. Financial, physical, emotional loss are some examples of loss that most people can relate to. Financial loss is a loss which results in your economic status being reduced. Financial loss is associated with risks or perils that are part of life. Examples of risk are market, financial, credit, and inflation risk. There are many others not named. Perils are events such as fire, flood, theft, and lightning. The meaning of perils is exposure to the risk of being injured or incurring a financial loss from one of these perils. Some risks can be transferred or mitigated. That's the focus of this article. Loss of income. Two primary perils associated with loss of income are premature and sudden death or disability. Premature death or sudden death. If you have dependents relying on you for support, it is especially important to protect people you care about from the economic consequences of a premature or sudden death. You can do this by purchasing life insurance in the amount that will replace your income for the number of years dependents are relying on you for their support. For example, if you want to make sure your 1-year-old child receives financial support until they're 21 years of age, simply multiply your current income by 20 years, and the amount of life insurance required to provide that protection is arrived at. When people are planning for retirement, people need to factor in a reduction in Social Security benefits when a spouse dies. Also, pension income might be reduced in the event of the spouse with the person who has the pension passing away. The amount of lost income can be calculated similar to the process discussed above by calculating the loss of income each year and estimating the survivor's life expectancy. Now, disability. The inability to produce an income is a devastating financial loss. Disabilities may be due to illness and accidents of some sort. Many employers offer group disability income insurance coverage, which offers a percentage of pay, typically 60%, to be paid to the employee if they are unable to work due to a disability. If this benefit is paid for by the company, then the benefit is taxable when paid to the employee. So a concern is how a primary breadwinner's family will be able to sustain itself financially on 60% of their current income, which will then be reduced by taxes. A strategy to consider is to purchase a policy which is personally owned by the insured to cover the gap created by the difference of what they were earning before the disability and what the employer coverage will provide. If you are self-employed, it is important to find out what coverages that are available for you for disability income insurance coverage. Without the coverage, you may be vulnerable to a devastating financial loss. Loss of property. Physical loss of property is an easier concept to grasp than the intangible concept of loss of income. Real assets such as a home, building, or car are appraised and valued for either market value or replacement value. Insurance is purchased, which will reimburse the policyholder in the event the property is destroyed or damaged. Property and casualty agents provide this service. Liability insurance is also part of coverages applied to home and auto coverages. If for some reason you are at fault for an injury on your property or something caused by your vehicle, liability insurance may provide the funds to pay for a lawsuit if you're found guilty. Umbrella liability coverage provides additional funds above and beyond what is provided from the liability coverage from your homeowner's and automobile insurance policy. The rule of thumb is to purchase the amount of umbrella coverage in the amount of 1 times your net worth. Other financial instruments can provide additional protection of your assets. Trusts can be created to provide asset protection when properly drafted by a skilled attorney. Healthcare expenses and taxes. When we're working with people who are transitioning from the accumulation phase, people at work, to the distribution phase, money at work, of their financial journey, the key risks we discuss are healthcare expenses, taxes, market risks, and longevity, which is running out of money. In this section, we'll be addressing healthcare and taxes. When you're working, ideally your healthcare expenses will be covered from a major medical insurance policy coverage. If you work for a company that offers health insurance, it will be employer provided, usually with some cost sharing requirements by the employee. When you reach age 65, everyone is required to enroll in Medicare. If you don't enroll, you will not be eligible to receive your Social Security retirement income. If people retire before age 65, you may be able to acquire private health insurance through the state programs. If you're terminated from employment before age 65, you'll be eligible for a COBRA for either 18 months or 36 months, depending on the circumstances of your retirement or termination. Medicare is comprised of Parts A, B, and D. Medicare A is for hospitalization, B is for physician's visits, and D is for drugs. Easy to remember, D for drugs. There are co-pays and limits for reimbursement, so people generally get additional coverage to help for these expenses associated with the co-pay and limits, which is generally called Medicare gap insurance. An alternative to Medicare is Medicare Advantage plans. Medicare Advantage plans are sometimes referred to as Part C plans or MA plans and are offered by Medicare-approved private companies that must follow the rules set by Medicare. It is important to consult with an insurance agent who specializes in Medicare to get the best advice regarding this important decision. Medicare Parts B and D charges are now earnings-based, so it's important to have a smart tax strategy in place to manage your taxable income to avoid higher Medicare expenses, which will be incurred when your income increases due to required minimum distributions on your individual retirement accounts. Long-term medical care is an important financial risk to assess as people consider their distribution phase of their life. Rather than acute or short-term medical care such as hospitalization, long-term care occurs when a person can no longer perform one or more of the activities of daily living, such as feeding, bathing, and walking. This type of care is considered custodial and generally isn't covered by major medical insurance. Medicare only pays for the first 100 days of long-term care, only if preceded by 3 days of hospitalization. For anyone who has experienced long-term care either directly or indirectly, it is clear that a long-term care health expense can create a catastrophic financial loss. There are strategies that will help mitigate this potential loss involving different types of insurance coverages, which can be tailored to anyone's personal financial circumstance. There are many taxes in the distribution phase of life that are not part of the accumulation phase. Required minimum distributions can increase your income tax. Surcharges on Medicare Parts B and D can increase your Medicare expenses. Your beneficiaries will pay income tax on individual retirement accounts they inherit. There are state and federal estate taxes that need to be considered. It is important to have a smart tax strategy for the distribution phase of your financial journey. Market volatility and longevity. People are living longer. This requires a thoughtful strategy regarding coordination of their income sources in retirement, such as Social Security and pension income, and how to use their investments in their portfolio for retirement. Generally, we segment portfolios into separate compartments based on what the purpose of the compartment will be. Investment portfolios for retirement should be segmented into an income segment so that your income will be, while working, is replaced, and a segment to capture potential market growth to offset the negative impact of increasing costs of living and increasing taxes. A key concept to plan for is sequence of returns risk. What this means is that if your first few years of retirement the market is negative, that will have a long-term effect on how your portfolios will be impacted. It may cause a person to have to adjust their standard of living and reduce withdrawals from their portfolio if the loss of capital is so great that continued withdrawals at the initial amount will cause them to run out of money. The strategy to avoid that risk is to figure how much income is necessary from the portfolio to maintain the standard of living people want in retirement and move that money to assets that aren't subject to market losses and can be used to set up an income strategy from the portfolio that will deliver that income every month regardless of what the market does. If additional portfolio assets exist beyond the amount segmented for income, the balance of the portfolio can then be allocated for growth. This approach helps to mitigate longevity, risk, and market volatility.